Welcome to the Stock Market Options Trading Show. My name is Eric, and in this episode, we're taking a look at just how profitable in-out debit spreads can be. And we're going to do this by looking at a debit spread strategy on TLT that made over 600% the past 5 years. And we're starting right now. All right, we're going to start in the option chain of TLT, and I want to first talk about what an in and out debit spread is. And basically, a debit spread is when you buy one option and then sell another option against it, all in the same expirations, a type of vertical spread. And the in-out part is really a relation to where those options are. So we're going to buy one option in the money where there's a delta of 50 or greater, and that means that that option, the price of that option, in this case the delta 54 as of this video is the 159 strike. Well, the price of TLT at the time is 159.60, so this option has some intrinsic value, so we call that in the money, right? The next option that we're going to sell against it would be out of the money. So you're kind of straddling the price with that, and that brings the cost down. We've talked about in the previous video. It brings the cost down, and it reduces some of your time decay and reduces your break even. Make sure you check out the debit spreads for beginners video that I posted not too long ago to kind of talk more about that. But we're going to basically look at an in-out spread in TLT using one option in the money and one option out of the money. So I'm going to just kind of go equidistant from price based on the delta. We're going to look at a 60-40. So if delta 50 is about right at where price is, we're going to go in the money 10 deltas. We'll do a delta, in this case 59 or 61. You can kind of pick and choose here. And then we're going to do a delta 40. So one option is 10 deltas in the money, and the other option is going to be about 10 deltas out of the money. So in this case, we would be buying the 158 and we would be selling, we'll call it the 160, I don't like half strikes. We'll do the 162. So in Thinkorswim, the way I can do this is I can right click the one option. I'm going to buy a vertical, and now it's going to pick the next strike, but we said we were going to do a delta 60, which is about the 158, and we're going to sell the delta 40, we'll call it the 162. So I'm going to switch this down to the 162, and this would be a delta 60-40 in-out spread for TLT, and that cost would be about $1.89 as of this video. And let's take a look at this on the risk profile real quick, just so we kind of understand how this trade makes money. Again, I covered this in the previous video. If you look at where price is trading right now, let's move this to the break even at the expiration, and I just kind of went 30 days out. We're going to look at buying these 30 days before expiration. We're using weekly options in this example. But basically the break-even price is at 159.88. Well, again, the stock is trading for, we said, 159.54. So the break-even price is extremely close to the actual price of the underlying. And what that means is as the stock moves higher, theta becomes in our favor, and it's theta positive, and the spread will increase in value from 189. Max gain would be 211, and the max loss, and I'm looking at this number here, is about $1 or 189. That's the cost we paid for it. Now we're going to look at a study here in a second that shows a strategy trading this over the last 5 years, but we're going to add in a little bit of profit taking and sort of a time-based stop for a reference. But before we dive into the back test, because this is ultimately a call debit spread, which is a bullish position, I'm going to add a filter for the back test that says I really just want to trade this if the stock, in this case TLT, which is a bond ETF, is in a bullish position. And the way I'm going to sort of measure that is I'm just using a simple filter where I have the 21-day exponential moving average, that's the blue line, and the 50-day simple moving average. And I'm basically saying, hey, if the 21 is above the 50, the market's in some kind of uptrend, and I would be interested in maybe buying a call debit spread with the idea that if the market continues higher, that spread would increase in value. Obviously, that's not always the case. It can fall off a cliff here. But if the market starts to downtrend, if you will, or gets too choppy, that 21-day exponential moving average is going to move below the 50-day. And at that point, I don't really want to do any bullish trades on this because, you know, it's obviously not in a bullish trend. So we're going to add that filter to our backtest. All right, let's jump over to the backtest software. I'm going to put links in the description if you're interested in learning more about how to use this software. If you're interested, I pay for this software. It's not a free software. But let's talk about the way I've set this up. So first of all, we're looking to trade about 30 days to expiration. We're looking at TLT. And real quick, if you're interested in seeing more information like this about different stocks or different tickers, go ahead and put it in the comment section about what you'd like to see, or maybe if you want to adjust the study. I definitely want your feedback for these type of, you know, analysis and videos. That would be cool to kind of see what you guys think and see if we can put some more videos out like this. So we're looking to trade this 30 days to expiration. This is 30 calendar days, by the way. And we already have our filter that I talked about on there saying, hey, I only want to trade this if we're about 30 days to expiration and the EMA 21 day is above the SMA 50 day. And you can see that over the last 5 years that this strategy had about a 75% win rate. The average price is about $1.50, which is kind of in line. We looked at Thinkorswim on that last trade. It was about $1.89, so that's pretty close. And this is how much it made. But there's some key ingredients here, and let's scroll down. We have the entry, but let's talk about the exit real quick. You can't simply just hold a debit spread to expiration, because if it goes in your favor and that sold strike goes in the money, you're at risk of early assignment, and that's something we don't want to do. And also, I don't like to be greedy. I'm not trying to get max gain on all these trades, and you've seen all the videos about taking profits at certain levels, So the level that I've sort of come up with that seems pretty good, there's some other percentages here, is we're going to look at taking profits if we get a 25% gain, or we're going to close the trade after 15 trading days. So remember, this is 15 trading days. That's actually 3 weeks. So let's talk through this again. 30 days before expiration, and it will use weekly options if that's the closest one. Only if the 21 EMA is above the SMA 50 day. Take profits at 25% and basically close in 3 weeks no matter what. If you have not hit the profit target, we're going to close that trade 15 trading days later. And if you think about that for a second, let's go back to the Analyze tab. So let's say we're sitting here and it's, it moves up, it moves down, and we're about 15 days to expiration. We could be down in the trade, but by closing before that last week, we're definitely going to avoid, in most cases, that max loss. Now, if the market just fell off a cliff, you could still get close to max loss, but ultimately we just want to close that trade before we hit expiration. And I thought that time-based stop was an interesting thing. That's something I'm still working on here, is this time-based stop. I got another video that's going to compare that a little bit, but I wanted to share with you just kind of a basic in-out debit spread showing some profits. And again, if you have any suggestions about some of these different entry and exit parameters, please put them in the comment section here on YouTube, and we'll see you at the next video.